Monday is a very sideways a day in most cases. Now, we're coming out of the non-farm payroll on Friday. So in most cases, what happened on Friday, the exact opposite is going to happen on the Monday as the market tries to digest that non-farm payroll number. So getting started here in a pre-market trade setup and checklist for entry, we're going to look at the AAA cross for primary direction and the critical pivot points, the short, medium, and long-term crossovers to confirm primary moves. We're going to identify supply and demand using the trend lines, and we're going to gauge momentum in the market with the predicted RSI along with a number of other indicators. So to get started here, what we're going to begin with is, you can see that my chart is basically blank here. I've taken all the indicators off here, and we have nothing but the AAA cross. So what we're looking at with the S&P 500 in the pre-market trade, is there anybody here trading the S&P 500 directly in futures? Not too many people. What's predominantly everybody trading? Energy, okay. Tech, yep. Mainly stocks? Mainly stocks then? Yep, okay, that's fine. Gold? I heard a gold back there somewhere. Anything else that we're looking at? E-mini, which is the S&P 500. That's good, yep, so that's terrific. So when we're looking at our basic trade setup using the AAA cross, the first thing we want to look on our trade setup is very important what I'm going to say here. How long has this AAA cross been in place? So when we look at this, you can see that the AAA cross from VantagePoint took place all the way back in November of 2016, and it's been riding up multiple occasions here. It has tried to break lower, it has failed. It's come back down here, it's done the same thing. So our current supply and demand areas are drawn in approximately coming in right around this 2275 area using our trend line. Now, with our key pivot points from VantagePoint, again, I've set up a lot of charts here over the weekend, and I'm just going to remind everybody how we do this. You want to disable your program so the mouse is not moving with this vertical line. You want to move your mouse freely, and you want to lock your vertical line right here. So basically, we can see we've got our key VantagePoint pivot points, 2278, 2285, and 2289. I believe that these are going to come under pressure very soon. So when we look at pre-market trading conditions, essentially they are already under pressure. So the two trades we have on that we're running right now, 2282, 2282, the market here is 2289. So basically what we want to be looking at is potentially clearing these trades up and letting the market clean these up. So the main thing we want to do on Monday is make sure we're protecting our profits. So we keep those. We've got, again, the 50, we're using the mirror account of the $52,000. We've got basically just under $3,000 in profit booked. So we want to protect that profit. We want to look on Monday to see what we can do for potential new entry points coming into the market. So as we come into the S&P 500, we want to start bringing our VantagePoint indicators slowly into this. Now, what I want to point out, and I've talked to a lot of people in the breakout session, this is not the ideal setup here. This AAA cross has been in place for almost 3 months. We're looking for the primary AAA cross for our entry points to stay long on this. We would prefer that to be within 1 to 7 days. Anything after that, it could be a problem. So right now, we want to make sure we've had our trades from the week that I put on that we can manage. We want to take these out, and we want to look to potentially re-enter today around 2278. So from here, we can bring in and utilize the VantagePoint daily predicted high and predicted low to assist us with that once we know what those critical pivot points are. So when we bring this down, we can see 2294 on the cash side of things today. This is essentially not holding. So that is what would prompt me to say we should clear out our S&P 500 trades, look for a potential new entry long only if that 2278 holds. Now, if we get into midweek, Tuesday, Wednesday, Thursday, this thing is going to really start moving. But right now, if everybody remembers what I had talked about, the S&P 500 has had basically about an 85% correlated to the US dollar. So the dollar's coming under pressure from the non-farm payroll number. It was very mixed. I've talked to a lot of people about that report and how to read it using the U6 number versus the U3. So right now, again, we've got 2294, but the predicted high and predicted low of the day, again, this is an estimate of where potentially the market's going to go the next day. It's not the be all and end all, and we don't have to simply trade off the predicted low and trade off the predicted high. We want to make sure that we're utilizing those critical pivot points that I've discussed. So when we bring this into play and we look at it closer, we have right now we do still have a triple EMA cross on the S&P, but our key pivot areas are 2289, 2285, and 2278. So those are three potential entry points that we can use to get into this trade. Right now we're testing 2289 in pre-market. The S&P has been trading pretty heavily overnight. We can see so far that the low today is 2288. That is a potential entry point for us, but I believe that we are going to go lower. So I'm going to bring up a live chart of the S&P. So we can assess here that we have our demand zone coming in right here, which is pretty much almost exactly in line, very close to the VantagePoint key levels. So when we combine those two, the 18-day predicted moving average at the 2278, we also have a demand trend line that we've learned over the course of the weekend. I've taught you guys how to draw a trend line. So you remember what we talked about. You've got a low point here based on current price, not past price. So the current price here is coming in. We connect it back to our next lowest point. That then creates a trend line from right to left. So that's coming in right around the same area. Ideally today, I would be looking for a pullback into this area to potential buy. If we break through this level, we want to cut those longs and we want to go short pretty much right away. That's going to be a significant trigger to get into this particular trade. Now, the triple EMA cross using the S&P 500, we're going to build off of that, and then we're going to go into our Forex trades also. But the S&P, when we're looking at the S&P, we now want to start gauging our momentum in the market. So a couple of key notes I would take down of what I'm saying is when that triple EMA cross takes place, and the triple EMA cross is the 3-day crossing over the 8-day and the 18-day predicted moving average. So I'm just going to demonstrate that again so we all make sure we understand where this is. This is this blue line crossing over the darker colored blue line, and then the 18-day. So they're all color-coded and marked on the top of the screen here, so everybody can understand what those are. So when this happens, in most cases, what's going to happen is we're going to have a pullback back towards that 8-day or the 18-day, and that would be our trigger to look for a long entry, which actually turned out very, very well. So right now, you can see that the 3-day has made an attempt to cross over this and failed. It moved back up to the upside. So believe it or not, even up at these ridiculous, all I can say, levels on the S&P 500, if somebody had told me a year ago that the S&P 500 would be at 2,300, I would say, well, there isn't a whole lot of reason why it should be up there, to be perfectly honest. So, but the buyers are still taking this. So when we look at this right now, we want to make sure we identify these key levels. Now on the S&P, we want to start bringing in additional indicators to tell us, is this current uptrend going to hold, or are we getting to reverse? So when we start bringing in very simple indicators, and I'm going to start with the predicted MACD to build on this, we can see that our predicted MACD, there is a lot of confusion. Now you remember what I said in my presentation of the reviewed indicators, basically through Reuters, Bloomberg, there's a couple of different research companies. The MACD turned out to be actually one of the most accurate of all indicators. So when we look at this, we should be paying attention to this. So right now we're above the zero line. We've had a crossover to the upside, a crossover to the downside, and now it's trying to cross back to the upside. So this simple, bringing this down, looking at these, we're above the zero line. We potentially have another cross here, but we've got a lot of indecision around this. So we want to continue to slowly bring in our indicators to create a template, which I did create a template for a lot of people, and I will have about an hour before, unfortunately, I do have to fly out today around 11, but I'm going to keep our presentation relatively short this morning so I have time to touch base with everybody to look at trades you currently have, and again, if you want a template created, that's very easy to do. And that basically you can load the program from default, very simple. So with our setup, the first thing we want to do is make sure we understand very clearly how that triple EMA cross works. We bring in our additional indicator. Our additional step here that we want to take, now unfortunately you guys with Apple, won't have that option. you'll have to do it manually, but this is what we want to do here. If you look at your keypad, anybody who's not on Apple, what we want to do is you hit Fin and then we hit F6. F6 is the short-term crossover. So the short-term crossover here is still up. So we've got our triple EMA cross to the upside. We've identified our downside pivot points to get into this. So the actions that I want you guys to look at and take in a step-by-step base, first of all, we look at that triple EMA cross. We're then going to look at the F6, which is the short-term crossover. We're then going to hit F7, which is the medium-term crossover. So this entire check, which is done at 6 p.m. Eastern Standard Time, when you update your software, you're simply going through a series of checks. First of all, the triple EMA cross. Is the market above the 18-day or below it? That determines whether it's bullish or bearish. We're then going in to check those individual crossovers one at a time. And all we have to do is hit F6, F7, F8. So when we look at this, we still have all three of the primary VantagePoint crossovers pointing to the upside. So if the market moves lower, this is, I think, when talking with a lot of people, not just here, but at other seminars I've done and people I've dealt with on Trader Planet, they think that if the market goes below the predicted low of the day, that the trend is over. That's simply not accurate at all. We want to make sure we're gauging the overall direction using a series of step 1, 2, 3 indicators, and then we can very quickly analyze this. So for now, this is pointing higher. So we've got all of this. We go back to our triple EMA cross. We bring our line back here. So we've got 3 crossovers to the upside. We've got the triple EMA cross still holding to the upside. So basically, and we've got a trend line coming in at 2278. So if you're trading the S&P, we're trading the S&P 500 today. It's Monday. We are going to stand and wait and see if we can get that pullback. We've come back to 2288. So to demonstrate how critical those 3 pivot points are that I just discussed, we can see that we have 2289. I know it's difficult for you guys to see that, but you can see it on your VantagePoint software if you can't see it on the screen. That's 2289 and 2285. So the market's already, for somebody who's looking at intraday scalping, they can buy as it comes down between that 3-day and that 8-day. We've got our all 4 crossovers actually are pointing to the upside. Those areas can be used as buying opportunities. That's what you want to look at. Stops in this particular case should be at the very minimum below 2278, the VantagePoint 18-day predicted moving average. Personally, I would lower my contract size, like Stanley said, on an E-mini, which is a better play. And for everybody outside of the US that I've talked to, the CFDs, I can talk to you about that before I leave also, where I would be putting my stop below that particular current trend line. That's our demand line. So basically the demand line tells us that that's where the buyers are coming in. It's all based on current price. So you can see where I've taken this from. Right here, we've got this low bar, 2 bars to the left, 2 bars to the right that are higher than that lowest point. You can see we connected back. So this represents a very strong area. We bring our VantagePoint into that. Everything is saying that right now, the S&P 500 today, probably tomorrow, will hold. Now, political situation over the weekend, actually pretty calm, not too bad. So maybe we're gonna have a good week, I hope so. And if everything stays smooth, again, most of the policies of the current administration do support your stocks. To be perfectly honest, they deregulating certain things, cleaning things up. It's not necessarily a bad thing here. It actually supports a lot of the stock trades. So, and again, without getting political in the least. Now, when we look at it, bringing in additional indicators, we've got our predicted short, medium, and long-term differences, and this is what I really want you guys to understand here. And I'm going to break this down so we can actually follow what these predicted differences, why they are so important. If we look at our predicted short, medium, and long-term differences, essentially, once again, guys, we have to bring this vertical line here. Do not let your mouse drag that line around. Lock that line in place. So you'll see right here, we are all color-coded. 9, 907, 2.83, 6.40 on the S&P 500. What this is doing on a short-term basis, so you understand this. So I'm going to go back to the short-term crossover for a second. What this is doing, the short-term predicted difference, is gauging the strength in the short term. and it's measuring the distance between the blue line and the black line. And that's gauging and telling us whether we're positive or negative and by how much. The ideal place to be taking these trades with the predicted difference is just above this zero line, but we don't want it right on that zero line. We want it moving up, which it's doing. So I believe that that's why the S&P 500 is continuing to rise today. So, but we're going to be looking at gold too, which is potential big problem for the S&P. So when we look at the medium-term predicted difference, we can see if we switch this over back to our S7, you can see that this number here, and again, always making sure that vertical line is there, this is a considerably lower number at 2.83. So what it's doing is at 2.83, it's measuring the distance between the blue line and the black line. We can see how close they are together. So essentially, in the medium term, this trend is developing, but it's not strong. It's not strong at all. So we want to be careful of that. We know we're at all-time highs here, so we've got to be careful with that. So when we come back to the long-term crossover, once again with the long-term crossover, we can see we're at 6.40. That again is measuring the distance between the blue line and the black line. So the wider that number is, the bigger that number is, the more likely it is it's going to turn and go back the other way. So you want to be very, very cautious of that. This is a case in point right here. We've got a crossover and we've got a good trend right here. The second this starts shrinking back, you'll see this number getting smaller on the long-term predicted difference. That will start shrinking down, right here. And that's when you want to be careful about continuing with that current trend. Now right here we've gone up, we've come back up, and you can see that it paused right around this zero line. And this zero line, we're kind of bouncing back off of it. That's a positive for these equity markets. That's actually a very strong positive in that particular case. So what you want to do when you're building your template, and the template I've set up defaulted it. Anybody who haven't set this template up before I go, I can show you how to do that, create it, load it from default. So whenever you load something on there, you've immediately got the perfect setup with all your indicators, everything you need. So these predicted differences are critically important that you understand how to use those. So when we're bringing that, again, moving into bringing additional indicators into this slowly. So we build that template, we've got our triple EMA cross. We want to start slowly bringing in the neural index, okay? So now the neural index I've talked about extensively, that it's a very powerful short-term indicator. There's nothing long-term about the neural index. It's a very, very short-term indicator, as demonstrated by this. For you day traders, this is what you're looking for. So once again, we've got the neural index up today, and I can't even tell you how many times that somebody has said to me, well, you know, VantagePoint was wrong. The predicted low of the day, the whole software was wrong. No, it wasn't. It was actually quite accurate. It showed us our critical levels using our key 3 pivot points. It showed our predicted differences are moving higher. Our neural index is up. So I'm still expecting, for the most part, to a degree of about 85% accurate, that we're still probably going to have a positive day. But what everybody has to understand is that you have a daily range that you have to play in every day, whether you like it or not. Nothing goes straight up and nothing goes straight down. It just doesn't work that way. You're going to have a big move up. You're going to have a lot of day traders are going to bring volume into the market, and then they're going to cut their trades and take profit. There's people like me will come in and out 2 or 3 times potentially in the same day. So every time they do that, it causes a bit of a push back down as they exit those positions. It doesn't mean at all that the trend is actually over. That's the key thing I want everybody to understand. So when we look at trading the S&P 500 today, because of that non-farm payroll number, I would expect probably a move down in and around the VantagePoint 8-day predicted moving average. But you can see that using these numbers, and I'm just going to highlight this so everybody can see this for people in the back row with my marker here, and I'll zoom in on the chart a little bit also, because that'll also be quite helpful. So when we bring this in, and I'm going to go into let's go to a 1-month time frame, we can see this very clear here, okay? So when we look at this particular setup and we understand how everything works here and those pivots, 2289, 2285, I would be looking potentially to buy the S&P 500 today between 2285 and 2278 as the market, and that has absolutely nothing to do with the daily report today. Okay, so the daily report is absolutely a very valuable tool, but it's identifying a potential range for that day and that day only. If it's a little bit lower or a little bit higher, that's just the market conditions on Monday trade, or you'll see the same thing on Friday. So if you're looking at the daily report, where the daily report is probably going to be the least accurate is Monday, and in my respectful opinion, Friday. People are coming into the market on Friday, big money is going out. They don't want anything to do with holding positions over the weekend. They have no interest in that whatsoever, and in some of the banks and in some of the broker houses that I've worked with over the years, they're specifically told by their bosses, get those things off the book. So be careful on Friday, be careful on Monday. That's where you're going to see swings until the market starts to develop. Now, we've identified the supply and demand zones using our trend lines, using VantagePoint. Now we want to be bringing in, again, the additional indicator to gauge whether we should actually be buying the S&P today or not. So when we hit apply, we're going to bring our RSI in. I'm going to drag this over so everybody can see it. Our RSI is telling us we have momentum building to the upside. I've shown everybody the strategy that I've come up with years ago, taking the RSI to a 60-40 split versus using it as an overbought and oversold condition. On the break of that 60 line, it's telling us we still, even at these levels, we still have momentum to the upside, where everybody and their sister is trying to sell this thing. VantagePoint continues to remain firm, saying that this is going higher. And once again, they were accurate. I would love to sell this thing. But it's been a sucker, to be perfectly blunt, it's been a sucker's bet. Every time a short goes in there, it pretty much loses. You get a couple of days here where they have the down days, but in most cases, it doesn't happen. Now, I can see a bit of a pattern forming here on these bars that we've talked about. You can see 2 bars up, then we have a consolidation day, then we have 2 bars down, 2 bars back up. So we're in a scenario here where we've got 2 up days again, but we're coming into Monday. So you want to look at basic price action to say, okay, what is the probability? We can talk about all the fancy indicators, all the fancy analysis in all the world, but the market is still going to determine the price. So you have to look at this and say, okay, the market is pretty comfortable buying the S&P 500 for 2 days in a row, then it gets a little nervous. And for you stock traders, I'm seeing the same thing in stocks. They'll buy a stock for a couple of days and then they get real nervous and they panic and they get out. You know, we used to hold stocks, I bet you a lot of people in this room, we used to hold stocks, I used to hold stocks for 8, 9, 10 months at a time. Now I'm not, no interest whatsoever unless it's got one hell of a dividend. So we want to remember that and say, okay, the S&P 500, when you're trading your stocks, the intermarket correlation here, because we do have a lot of stock traders, if this S&P 500 is going up, your stocks are going up. Every one of your stocks is probably going up, but the second that S&P 500 turns down, the likelihood is it's going to drag all of your stocks down with it, regardless of what their earnings are, regardless of how much cash that company is sitting on, all of these different multiples, variables. S&P 500 goes down, your stock is going to go down. So if you're a stock trader, but you're not trading the S&P 500, you're trading it whether you like it or not. That intermarket correlation is absolutely vital. You have a question there?
Yeah. What you just said about not holding stocks means that you're either in a trade or you're cash?
I'll go to cash as often as I possibly can, unless there's a strong dividend there. Yep. If the stock looks good and the S&P 500 is healthy, then I will stay in that stock much longer. I'll stay in some, I'm in a couple of stocks now, NOG, a couple of smaller cap stocks that are doing well, and I've been sitting on them for about 3 weeks. But now they're just kind of flattening out. They're doing nothing. They're going sideways. So remember what I said, if you don't take money off that table, if you don't take money from the market's going to take it from you. It's a zero-sum game, regardless of what everybody is saying about this and that. Even in stocks, it's still a zero-sum game. Either you know, it's me against you, right? So if you think it's going higher, you're willing to hold it. I think it's not. You know, we've got people that wisely sell puts, you know, because they're covering it, right? So we want to make sure that I'm not by any means saying buy 10,000 shares of a stock and get out in that afternoon, because I know a lot of people are doing that. And again, that's why I've tried to turn everybody over a little bit or expose everybody to the Forex market a little bit, because you can do it there with so much less cost, and so much less, you're not taking thousands of dollars of your own money out of your account. Like, what happens when the market closes and that company earnings are no good, or they file for bankruptcy or what have you? You've got all this money in this stock, you're stuck until the next morning. How many times has that happened? Too many times for me to even count. How many times has that happened in the Forex market? 0. It's never happened. So that is one of the benefits. One way or the other, you can get out. In a stock, an option, you can't. You're stuck. So we've got to be very cautious there. So when we look at this, we want to gauge, essentially the best thing you can ever do is combine a leading indicator with what they will call, everybody will say to you, a moving average is lagging. To some degree it is, but there's a reason for that, because it's trying to confirm price. So when we're using those short, medium, and long-term, particularly the short, medium-term crossovers from VantagePoint, combining it with a momentum-based indicator like the RSI, and not using the RSI as an overbought or oversold condition, then we have a much better chance of being accurate in the direction in which we're trading. So as the S&P 500 gears up around 9:30 a.m., it continues to hold 2288. So 2288 is the current price of the S&P 500, which I can probably put up there so you guys could see it a little bit better. But on your computers or your live trading platforms, you'll be able to see it. But the current price right now, the S&P 500, is sitting up here at 2291. So we're holding that VantagePoint 8, that 3-day predicted moving average. So as long as we're holding that, the short, the medium, the long-term crossovers are all pointing higher, without fixating on the daily report and only simply looking at the predicted high and predicted low. There's still a buying opportunity here. At the end of the day, that's what we're looking at. So we want to make sure we understand that. But as we come in, we want to make sure we take profit, let things, at the beginning of the week, the best advice that I can give you guys is let the market form a direction. So basically at the end of today and the beginning of tomorrow morning, we're going to have a very clear picture as to what the S&P 500 is going to do for probably the rest of the week. And every week, week after week, month after month, year after year, it's the same deal. The bulls and the bears are fighting it out at a certain level right now. I hope I clearly identified that level for you guys. We've got our 18-day predicted moving average. We've got our trend line support. We clearly know where the line in the sand is. Once we identify the supply and demand zones, the critical VantagePoint pivot points, and then look at those individual crossovers, we have everything we need in this particular setup to guide us in the direction we want to go. So we can I could pile on 20 more indicators here, guys. The only other one I'm going to say you should be using is, again, is the strength indicator. Do we actually have strength in the market? The strength indicator, once again, that vertical line drives me nuts. So we got to make sure our vertical line is over here, so it gives us all of our information. So you can see P strength. It's 10. If that's a negative number, it'll show a negative 10. So it's just 10.0, it's positive. So everything basically we're looking at here today is pointing towards we should be buying the S&P 500 on a dip. That's what it's telling us. We can clearly identify where we want to get our stops down here. The minimum stop is the 18-day again. The lower trend line is where I would keep just out of that broker radar. That is the key thing we want to look at, and again, look for a buying opportunity. So while we're standing here, we've come down to 2288, 2289, and we keep bouncing right back up to 2291. So even for you scalpers here today, even in the 20 minutes that I've been standing here, we can take 3-4 trades, in, out, in, out. In the E-minis or the S&P 5, in the E-minis, you're going to have to wait probably before you can get into that trade. In the future side, you can already get into that. CFDs, you can get into that trade. But the critical thing is to understand that while everybody is trying to sell this thing, VantagePoint ultimately is telling us it's going higher. So to make sure that I stay on schedule here, I'm going to keep moving on to what we were looking at here. So the gauging momentum, now again, I've talked about a lot of this already, applying the daily report, overbought, oversold conditions. I do want to touch base on the overbought and oversold conditions, what to use and what not to use, okay? So when I bring this up, you'll notice throughout my entire presentation, I really didn't spend a lot of time with the stochastic. Now the stochastic from VantagePoint is certainly one of the better ones that I've seen, but I'm not going to rely on a stochastic for anything, guys. Okay, there's only one setup that I'll show you that actually works. Now, what I want to point out with the setup that I use, that I've taught you guys using the predicted RSI and the break of the 60, let's compare that to the stochastic, because a lot of people want to use only the stochastic. The stochastic here, as the RSI started building momentum on the S&P 500, you can see the stochastic within a matter of days went into overbought territory. And the average trader is going to, well, not just the average trader, even top-notch professional traders, they want the easy trade. They want to sell this. The S&P 500 has continued to rally for months after that. At the start of the rally, the S&P 500 told us to get out of this. No. You want to make sure you're gauging it properly using the 50 and the 60 level and the 40 level of the RSI. Only when we break, and you can see as the market came down, the RSI never broke below 40. It broke below 50 very briefly, but it didn't break below 40. So in this particular case, you can see that one of the best times, or one of the times that I will use a stochastic is when it's coming out of a condition like this where it's gone on. This has gone on. Basically, the indicator is essentially useless for a matter weeks and weeks. Doesn't mean it's a poor indicator, it just reacts a little too quickly. So with a momentum-based indicator like the RSI, it's basically telling us that we're even right now, it's telling us. So when we look at the stochastic here, this is where I'll point to you guys where I do like the stochastic. So right now, the momentum based around the predicted RSI and the break of the 60, the crossover here on the stochastic right in the middle. And there's a zero line on the stochastic also, but it's called 50. So your zero, you can see right here, 0 to 100, we're at the 50, right? So the 50 is just like a zero line. We have a crossover on that 50 line. Anybody trading today, yes, you should be buying the S&P 500. And everything that VantagePoint has is confirming that using a multitude of basic indicators without getting really super complicated with waves, Fibonacci, Gann theories. I've seen so many theories over the years. It's most traders, complicated candlestick patterns. You can see all I'm using here is bars. A bar is a simple tactic, right? The notch on the left is where it opens, the notch on the right is where it closes. That's where we want to keep it very, very simple. Is the notch on the right closing above or below the VantagePoint 18-day predicted moving average? It's been repeatedly closing above all three of these lines. The short, medium, long-term crossovers all pointing higher. RSI building momentum. Even our stochastic, one in a million shot, it's perfect where it is. And you can see that our predicted MACD is trying to cross the trigger back to the upside. Predicted short, medium, and long-term differences above the zero line with the neural index and the strength indicator. This is how you build a template, guys. And what you're applying here, the S&P 500 is simply what's on the screen. You've got Forex, commodities, you have all of these things that will apply with the exact same strategy. Your individual stocks, take the exact same setup with your individual. I don't trade stocks, futures, commodities, even ETFs. I don't trade them any differently than the way I would trade the Forex market. Now, when we want to get in, that's as much as I'm going to spend on the S&P 500. We're going to keep it moving here to make sure that I have time to talk with everybody before I go. So we're going to move into once we've got basically our main setup here, I'm just going to simply, actually I'll leave, for the purpose of today's presentation, I'll leave the stochastic on there. All we have to do is once we have this template in place with all of our indicators that we're using, we simply hit apply to all to everything on the screen. Everything in that particular portfolio, this setup will go right across that portfolio. Once you have that, you can then take it one step further, which I've done for a number of you guys. You can go down here and you can click on Save as Default. That becomes your default template for any time you load up a new market. That's what you'll get. All of this setup, 2 seconds. You don't have to set it up. You can create a new portfolio and then just hit load from default. That's all you have to do. Now, when we hit this, I'm going to hit apply to all. We're going to move over into the commodity market also. Same thing here, guys. So now we're moving into light sweet crude oil, okay? Light sweet crude oil, This one is still, basically, we've talked about this one. A few guys have Canadian futures contracts long. And what I told you guys, and I can look at them again before I go, is that you want to watch light sweet crude oil very, very closely. So right now, we've got critical pivot areas, 53.12, 53.21, 53.58. Those are our three key pivot areas, right? So we know that we are currently trading oil. Right? So our oil right now, the current price of oil, this is a live chart. Let me bring it over to the chart so you guys can see it. We have critical resistance sitting up there at 54, okay? So in this particular setup right now, does anybody see anything a little ominous on this chart? Just out of curiosity, if we know and understand how to draw trend lines properly, is it potentially a new trend line forming off that bar right there? The answer would be yes. You've got a swing high right here. So I'll draw this in. So this is where I want everybody to make sure they understand where it is. And I'm going to draw a big old arrow to it so you guys can see it. That bar right there is now a swing high. This directly leads into order flow trading. So what order flow trading is here, guys, I'm going to move it around, keep things moving to make sure I get everything in. That point there is almost identical to our other swing high right over there. So if we look at this right now, order flow traders are going to be watching this very closely on this particular bar. So if we just draw a straight line right across there, it's going to come in right on that third bar from the right there. So that is a problem. VantagePoint is still forecasting ultimately to the upside that oil is going up. It's been a very good particular trade. We can see we're at 52.75 on this. We've got about $850 in profit over a couple of days. But this is starting to move lower. And we have a new trend line forming there. So we have to look closer at the VantagePoint indicators to make sure that we're okay to stay long here. And I'm not really convinced potentially that we are. So when we look at our indicators, we know where these key levels are, 53.21. At this particular time, I would be very, very wise to move this stop, and that's exactly what we're going to do. So we'll take this stop on this particular trade and move it right up to that level, and I'm going to move it up to 53.20 and change it. So this is what we had talked about the other day about moving stops to your entry point. So we have a trade that's on it at 52.75. We've now locked the profit in at 53.20. No matter what, this trade is going to be a winner. I'm not letting this thing get away from us. That'll lock in about $600 in profit, but I'm not going to panic and close this thing. I'm just going to make sure I've locked the profit in, and I'm going to let this thing play out, okay? So either way, it's a winner. It's just a question of how big of a winner it's going to be or how small. But by saying I'm willing to accept $500 in profit. So why am I willing to accept $500 in profit? It's a $50,000 account. Then I'm going to say I want that 1%, right? Most people are averaging probably 4 or 5% per year. I can do that on a single trade, unleveraged, right? So I'm not willing to give that money back. And when I lock that profit in, that opens the door for me to move on to something else. I don't need to worry about this trade anymore. I can come back and revisit it, but I'm not going to worry about it, right? So I've got a winning trade. I'm going to let it go. So when we look at the indicators from VantagePoint on the oil side of things, no, it's opening above it. The opening on oil today?
Or is it open already?
Oil is moving right now. That's a live chart. Yeah, you can see the numbers are moving right now. 53.66, it was 53.40 there a minute ago.
How do you have access to it? We can't trade until 9:30.
With oil futures, you can get on sooner than that on the CFDs. On the futures side, on stocks, you can't trade it till 9:30, no.
Okay.
No, but on the futures side, you can trade. It's trading overnight.
You can trade that 24/7.
There's a small window when it's closed of about an hour, but the rest of it, it's pretty much around the clock. Again, another disadvantage of the stock market, whether you're trading ETFs or stocks, you got what, 6.5, 7 hours?
More. Well, for me, it's more.
A little more, yeah. Yeah, the actual time the exchanges are open from 9:30 till 4 or 5, yeah, you've got about 7 hours there. So no, and the future side of it, everybody's buying and selling oil all night long. It's moving around, absolutely. So yeah, because normally if that was not tradable, I wouldn't be allowed to move that stop. It would reject me just moving that stop. It would say no. So about an hour a day, there's a switchover period there that it closes. Other than that, it's open basically around the clock, except for Saturday and Sunday. So when we look at oil, again, oil is a big one on the trading side of things, but essentially we've got a triple EMA cross right here, and this is critical what I'm going to say here, guys. For buying oil here today, this is an easier one. We've got 53.12, 53.21, and 53.58. So these are the key pivot areas. So actually buying oil anywhere down near this is very good. So once again, we look at that daily report. You'll notice that every time I do the analysis, the last thing I look at is the daily report. It's never ever the first, always the last. So from there, I've got my key pivot areas down to 53.12 on oil, and then when I look at this, you can see I've got 53.06 as the predicted low in oil today. That's very possible we could hit that level. But if it doesn't hit that level, people will say, well, and this is another comical thing that I often hear, people will say, well, VantagePoint said the predicted low of the day was going to be 53.06, and it only went to 53.20. They were wrong. Well, were they? This is where we have to look at this thing. So if you understand this right now, it's not that VantagePoint was wrong, it's that it couldn't get to the predicted low. It couldn't clear these numbers. 53.58, it's already breached that. 53.21, 53.12, those are your key pivot areas in a long trade or any type of trade. But people will ignore this, everything that's being said in this chart with these indicators, and they'll go to that daily report and ignore everything else. So first and foremost, you want the direction of trade. Is the current trend in place? I would say yes, it is. We've got our triple EMA cross. We've got our key pivot areas. The market continues to hold above that. We've had 2 retests of the VantagePoint 3-day and even the 18-day on that volatility on Friday with the non-farm payroll, and the market is held. So right now, it is saying that we are likely going higher on oil. But again, nothing goes straight up and nothing goes straight down. It has to pull back inside of that daily range. We want to buy lower on a pullback if the indicators support that. In this particular case, they do support that. So we're looking to buy, and then once we've got our trend line drawn in, that's coming in around, basically around 52.70, right where I picked it off that demand line. So if you know how to draw these trend lines, put them in properly, there's our current price we're drawing our trend line off of, then we're dragging it back to the next lowest point. That creates our demand zone. So you can see it came into the demand zone, and the buyers like me were just absolutely sitting there waiting for it. So always let the market come to you. Don't chase after it. Don't try and sell down to that level or buy up to this level. Just patiently wait. Quality, not quantity. The more you trade, the less money you're going to make, to be perfectly honest. Look for easier setups like this and then play them. This trade here, I don't have to have a big stop on it. It basically became profitable almost immediately. It's still holding in there at $931, and again, that's about 2% of the value of my account. So I want to make sure I'm locking that profit in. By moving my stop up to 53.20, I can lock in that profit and say, okay, no matter what, now this trade is a winner. I don't have to worry about this. So it allows me to move on to potentially bigger and better things. The indicators from VantagePoint, are they supporting everything I'm saying? Not 100%, no. Once again, the stochastic becomes a very useful tool here. When it's up above the green line, when it's down below the red line, the stochastic, ignore it. It's not going to give you an accurate signal, but I believe that this signal from the stochastic is a good one. It's crossing over the trigger here again, but the RSI, this is why we combine our indicators. Our predicted differences are all basically sitting more or less flat. We've got 10, 16, 20. So it's still okay. It's just above the zero line right here, but there isn't a lot of momentum. And when I talk about bringing momentum into our trades, you can see the RSI is unwilling to break that 60 level. This is not a coincidence. If we have momentum building, we're going to break that level. So when we had this triple EMA cross over here, you can see that when we broke the 40 level right there, that triggered a move in the market. So right now, if oil is going to make a big rally up, then we need that RSI breaking above that 60. And then we've got the green light not only to hold this trade, but that's when I would also look at buying additional contracts on that. So for now, our oil trade continues to hold in there at $930, $940. You can see that this is moving now, $940. I'm hoping we'll get up over 1,000 before I'm done. That's my plan here, but that'll be up to the market, and you know, if the VantagePoint indicators support it, which I think they ultimately will. So when we're looking at these indicators again, you know, do we have a new trend forming here? Is the current trend still in place? Yes, it is. The other thing I want to talk about here, which is a big one that I want everybody to make sure that they understand when we're looking at oil, you'll notice here that I have a vertical line and I have a horizontal line. The date of this is December the 30th, 2016. The market closed on that day. That number in everything you guys are trading, whether it be stocks, futures, commodities, Forex, doesn't matter. What I want you to do is draw that right onto your screen. So what that is what I will now consider to be the yearly opening price. So when I talk about advanced trading with the yearly opening price, remember what I've talked about with the 18-day predicted moving average. Above it, we're long, below it, we're short. It's giving us a clue as to who's in charge here. So when I look at this, the yearly opening price on oil is approximately $53.79. So what I'm looking for is for oil to get above that price, and that's going to confirm a bullish move probably towards $60 a barrel. Now, when we look at this, you can see that on multiple occasions here, the market has continually, since January 1st, has tried to get above that simple white line that I put on the screen. So all you have to do is look at your stock chart, your futures, your Forex charts, and identify the closing price, or you can use the January 1st or January 2nd opening price, whichever one. It doesn't have to be the perfect number. In this case, I always choose to use the last trading day of that calendar year, which is December the 30th. So I put that price on there, that comes out at $53.79. Like a moth to a flame in Forex, the market will always come back to this at the end of the year. So not only is this price of critical importance in the first quarter of the year, in the fourth quarter of the year, it comes back with a vengeance. And the market, like a moth to a flame, comes right back to it. And it's amazing. Every year I see it almost the exact same thing. So that price right now is critical. So when we look at this and we talk about the new trend lines forming, this oil contract becomes even more concerning now, doesn't it? Because we have what we've identified here is a swing high up there. We've got a trend line forming into this particular area, and we've got the yearly opening price sitting right there. So if we break below that yearly opening price of 53, if we can't hold above 53.79, the yearly opening price, then oil's going lower. And let's face it, if we bring in basic fundamentals of supply and demand, the market is flooded with oil. It truly is. Stanley, yes?
Is that only in oil that coming back to the end of the year? Or?
Oh no, I use it in everything. Everything. And to show you that again, that's a great question, Stanley. As usual, you've got very good questions. The yearly opening price on the S&P 500, $22.39. So if we combine $22.39, the yearly opening price, with all of the indicators that we spend a considerable amount of time on the S&P 500, because I know you guys are a lot of stock traders, and that's why I've done that, that the S&P 500 has shown itself quite clearly from January 1st. And it's gone basically straight up with the VantagePoint. So as long as it holds 22.39, like, let's face it, that's how most of everything is gauged. Your performance, my performance, everybody's performance basically is gauged in stocks, is gauged against S&P 500. So if the S&P 500 has done, XXX on the year, then I have to meet that performance. That's, your stock traders. Well, mutual funds, we talked about that at length. Mutual funds, do they match that performance? Not even close, not even remotely close. Look at the money that's made on the S&P 500 versus your mutual fund accounts. So, years ago I went back to because I was just trading commodities, Forex, and my retirement RRSPs is what they're called in Canada. And I said, what's going on here? The S&P 500 has gone up X amount, or the TSX in Canada has gone up 30% on the year, but my count's showing 3% returns. I think we might have a problem here. So, needless to say, you know, you're fired. So that's enough. I had to end up. I don't want to trade stocks. I don't want to trade the RSPs. I had no choice. I had to take it over because it was so poorly mismanaged. They didn't care. 80% bonds, 20% stocks, 20% stock, or 80% stocks, 20% bonds. That's how they work. So, you know, if you don't take over this for yourself, that's what you can expect. When the market crashes, is your mutual fund guy going to call you and say, I think we should shift everything over here? No, he's going to say the famous thing, it'll come back. One of these times, guys, it's not going to come back. We've never, does anybody know why, like on the S&P 500, for example, that I don't have a supply line, an upper trend line drawn in here? The answer is simple. We've never been up here. I have nothing to draw it against. So I've got a demand line, but I don't have a supply line up there. I can't draw a trend line because there's nothing to draw it against. So we've got to be careful here, right? So Stanley, I think, or
You're saying it's going to come back to that by the end of the year?
I am absolutely saying like a moth to a flame, it's coming back to this number. And in 2016, 2015, 2014, if you look at your charts, you'll see the same thing. And what's funny, particularly in 2015, in 2016, it came to the exact number in halfway through the year, and the buyers were sitting there. They just, like, they came in like a swarm of locusts again and just bought the living heck out of this thing and drove the S&P right to where it is now. So it's not like we didn't have a massive pullback in 2016 on the S&P, which very few people are talking about, but we did, and it came right back to the yearly opening price. So when you draw that onto your charts, you'll see it clear as day. But it's always understanding where we are in this particular cycle. So once again, guys, to simplify it, Stanley, is that the further we move away from 2239, the probability that we're coming back to it is very, very high. And I think I got two questions on the go here.
Well, what are you going to do when your bank or your broker goes bankrupt? Because you're not insured for all your money if you got hanging around in cash.
Well, you're not. I am. Well, yes, you are. You're from Switzerland, you said, right? No, you've got investment protection of funds. Canada, we got $1 million. Our American friends, not so much. No, that's true. But you, what do you guys have? About $250,000, 250,000 protection?
Yeah.
Canada's got $1 million. So, you know, if you can get a, thanks, Nancy.
Don't say it, they'll all move to Canada.
Don't say it, they'll all move to Canada. There's what Stanley's saying. But yeah, it's worth it if you have a Canadian address. So, you know, it's not bad. But you could definitely
Well,
get.
we have it per bank per client, so you got to spread your money around otherwise, you know.
Yeah, that's true. And even me in Canada, I still spread it around because I want to trade Forex through the Forex brokers. But most of them do have some degree of protection. But the regulation, this is why we don't want to cut too much regulation out of things here, because some of that, a lot of that regulation, I don't disagree. It's horrible. But some of it's good in the U.S. where, like for example, the Forex brokers, they used to only had to report once a year to the NFA, CFTC, that's who regulates me, who I'm licensed through. Now they have to report every day, sometimes every hour. And that's how they caught some of the brokers when the whole Swiss franc debacle thing, they made sure, and they said, nope, you allowed this leverage, now you have to cover it. So now they're only allowed, the very next week after that happened, the margin rates in the US were cut in half. And even across Europe and Australia, New Zealand, they said, nope, this leverage is now off the table. You can go as high as 30, or Canada is only 30 to 1. You guys, I think, can still get, you know, up to 200, right? 100, but they've taken that away from us. No, they're saying that's too much. This broker is going to go out of business. But I don't think we have to necessarily worry about that right now, but it's something to be aware of. Like in the 2008 crash, and I've said this in many presentations, all everybody in this room had to do was not listen to our brokers, not listen to the mutual fund guys and say, you know what, liquidate my positions and go to cash. The only person that would have been bankrupt is Wall Street, but that's not what they did, right?
Well, we were pretty close to money ceasing to exist at that point in time, but...
And most people don't realize how close we were. Absolutely right.
I was standing in the trading room there going, we were just about...
We were this close to the end of monetary money as we know it.
Fiat money as we know it.
You got it. And most people still to this day don't understand how that. I could spend the rest of the day talking about that up here, but.
Yeah, which is.
Yep.
When I asked the question, I would rather have in I don't know, cowrie shells or whatever, But I would still rather have a stocking BMW because even after the crash, they will come up or whatever, one of those, which is
Yep.
why I'm kind of,
Oh yeah.
why I asked the question.
And even some of your utility stocks, they're not going anywhere. They kind of came through it okay. But your main tech stocks, a lot of the energy stocks, oh, it was a bloodbath. It was, oil went down to $29, $32 a barrel. It was horrible. Yeah. But that's right. So, yep, but we'll keep moving here. Sorry, I did have a question over there too.
Yeah, my question was, so would you see price coming back to that opening price multiple times during the year?
Yes, potentially. And then what's going to happen is you're going to have the bulls and the bears fight it out down at this level. And that's not just in the S&P, that's in Forex, that's in your stocks, that's in your futures, all of those markets. So what could potentially happen is it's going to come back down to this area, and that's going to be essentially your line in the sand. So any of your bigger hedge funds, your private funds, they're all long and their performance is based on this. So the second the S&P goes negative, all of a sudden their performance has gone negative, right? Yeah. So at that time, they'll switch over and go short if we break through that level.
I feel like it breaks through and then eventually later in the year maybe it comes back.
Well, what I see, and that's a great question by the way, to clarify that, is it'll break through, and this acts as a pivot, just like what I've taught you guys with the 18-day predicted moving average. It could break down violently below it. What's going to either happen, it's going to come back, hit it, touch it, stay there, and then start to slowly or violently rise back up, which is what happened in 2016 and 15, or it's going to breach it. And then there's going to be a substantial move down. It's going to retrace back up almost exactly to the number and then just collapse. And there's your trend change. Most people have no idea about that number. They have no clue. They don't even look at it. Has anybody heard anybody else in the presentation this weekend talk about that number? That's one of the most important numbers you should know, is that opening price of whatever investment vehicle you're in. You simply want to draw a straight line across your screen and play off of it. It doesn't, DAX everything. The DAX, you might as well just call that the S&P 500 Junior. That's what it is. It's following, like I could put it up on the screen, or before I leave, I'll show you. Put your S&P 500 and your DAX side by side. They are 100% moving together. Other than a couple of blips from your ECB there, they're trying to talk it up and down, right? They're trying to talk the euro down is what they're doing, but that's indirectly pushing the DAX up. The same thing as the Fed did back in 08. Every time the dollar strengthened, the equities collapsed. Well, that's what's happening in the Eurozone right now. You're either, if the DAX is going higher, the Euro's going down. The second the DAX goes down, the Euro is screaming higher. Guys, we've already seen this. It's an easy play if you know what this basic fundamental is. That's what's going to happen. So right now, we're seeing it again right now. The Euro is at 107. It's given up 80 pips on the day. I'll tell you right now, I don't even have to look at the DAX chart. I can tell you it's up today. So that's the way it's going to play, at least for now. So no, well, well, remember, it's going to wait for the overlap, right? If that's down, then chances are the DAX is at least positive in some degree, or it will be after 9:30. Or money is moving in there, anticipating it going higher. So what we're going to do is we're going to keep moving here, because I've got to make sure I stay on time here today. Now let's go quickly over to gold. So gold, this is the other reason, the other thing that's driving the euro currency down today is the DAX, but the gold contracts are still very positive. So when we look at gold right now, gold is moving higher. I believe the euro potentially could recover today, and that would force the DAX down. So as long as the gold is moving higher, and again, when we look at these indicators right now, we are approaching, again, overbought in the stochastic, but the RSI is not. The RSI is again still advancing above that 60 level. We've got a failed triple EMA cross to the downside. Here it started to reverse higher. So if the euro recovers today, then the euro, in order for the euro to move higher, we need the DAX going lower, and we absolutely need gold going higher. So when we look at gold's price for today, where we're currently at on gold, we're sitting at 1227. So I'll take that back. I bet you the DAX is going to be in trouble today. So when we look at, it's down almost 1%, and there's your answer why, gold. So The question I'll ask you guys right now is, who thinks right now we should buy the euro currency? Gold's at 1227. That, in my respectful opinion, is nothing short of a breakout. And the reason I'm saying that, remember, we've got our supply and demand areas right here, okay? We pushed above there, we tested it, it's like a cow. Some of the guys, I remember last year, the seminar I was in, I talked about like a cow poking its head out of the fence, and the farmers there are whacking it in the nose as it tries to break through the fence. Well, the cow got out right there. It's running. So if I'm looking at this right now, the euro has come down to 107.05. So when we look at gold right now, gold is definitely positive. So this would take me immediately to the euro currency. So the euro currency, and this is where I'm saying, if you're a commodities trader and all you have to trade is gold, you don't realize you've got a Forex trade here that's way easier. Would I recommend a long on the euro US currency right now based on what I'm seeing with gold? Absolutely I would. The key level, 106.91, okay? So we're at 106.91, 107.40, 107.70. So for everybody that can see this, and I can show them after the fact, we have come down to a low of the day on the euro US currency to 107.05. It has come back and kissed that VantagePoint 18-day predicted moving average, and now it's rising off of it. So have we missed this trade? Of course not, guys. We can go long on this trade right now in the euro US currency. And you can see that basically I made that call to get long on that, and I will be getting long on that in a second here, is the fact is that gold is breaking to the upside. You remember in the presentation on Saturday that I said we've got the US unemployment rate and they're saying how good it was, and I actually in the room said it wasn't that good. Because I based it around looking at the U6 number. So whenever you read things, look at that U6 number and see whether the overall unemployment situation is good, bad, or indifferent. So would I recommend that we go long on euro US right now at 107.24? This is a relatively easy trade, guys. Gold is screaming higher, okay? We've got confirmation. I haven't had a chance because I'm running a little behind this morning, so I had to rush down here. I haven't checked the European equity markets. They're down. That's confirming that. So when we look at this, brings us an excellent opportunity. So the first thing we're going to do is we're going to test the waters here with a 0.5 trade. We're going to put this thing on right now. Okay. So you can see the cost for me to take a $50,000 position on the euro US currency is nothing, like $6. That's all that's going to cost me, right? So I'm going to give this trade, remember we've talked about 1% of the value per day. So we're going to take this here. We're going to back this up and we're going to put 106.50. Oh, 106.50, that's 100 pips. So the most I can lose on this is 1% of the value of my account. $5 a pip, that's a 1-to-1 trade. So once again, guys, I'm not going to put on a $2 million trade to show you guys $3,000 in profit in 2 minutes, because that would be deceptive, because that would mean that I'm suggesting that's something you should do. You shouldn't do that. You should trade at a maximum of 2-to-1 of the account value, and that is it. And small profits, lots of them, that's how you make money. But leveraging out, you're at the mercy of the broker, you're at the mercy of the market, you've got all kinds of problems if you do that. Okay, so you keep it in check. So we're going to let this thing run. We've got our oil trade here that potentially could start to come under pressure, but it's not. This one here, this is VantageFX, which is based out of, they've got several brokers in Australia, the UK. The European platforms I prefer, the Aussie platforms I really like. Yep.
On that euro trade, can you explain your decision on the stop loss?
The stop loss?
Yeah, the level.
Basically what I had talked about was that currencies move 1% of their value per day, right? So 1%, we simply take 1% of the value of the currency, which would be about 107 pips. So I would use at least 100 pips in this particular case, provided the trade is unleveraged. But from a money management standpoint here, guys, what you really want to watch is never, ever risk more than 1% of the value of your account on any given trade. Do you know how easy it is to make back 0.5% of the account, 1/4% of the account, 0.75% of the account? You know how hard it is to make back 4 or 5%? 5%? Ugh, you're digging yourself into an early grave here. So we don't want to go down that road. It's very volatile. That's not something that we want to do. So we want to give this a chance. So when we look at the euro currency and we look at our trade here, we want to make sure that we understand how this, you know, how this all works. So when we look at the euro pair, very easy if you have the Forex. Most of you guys have commodities. You don't have to split the screen if you don't want to, but it's just simply a way of showing you guys how intermarket analysis works. Does it actually really work? So we've talked about the DAX, we've talked about gold, we're talking about these things, we've talked about the dollar index. So when we look at gold, this is indisputable. Gold is giving us an early warning sign, it's going higher. We talked about this on Saturday. So VantagePoint is already saying that gold is going up. If gold is going up, so this is where it gets confusing for people because the Euro US currency fell all the way down to 107, but currencies move within a 1% range. So it's going to come down near that predicted low, or it's going to try and fake you guys out, and they're going to send the euro lower, but that represents a buying opportunity for us. We want it to go lower so we can pick it up. We wait, we let the market come to us. That's the play. So as long as, yes?
Well, I don't trade these that actively. But what I do is I have a very large position in gold held in Swiss franc.
Okay.
Swiss franc.
Yep.
Fund, but when VantagePoint shows me trend reversals or whatever, then I hedge that. So how would you do something like that? I want to hold on to my old position, no matter what. That's part of my portfolio.
Right.
Whatever, 10%.
So you would use, you would use options then to hedge that position.
Use options then hedge that in both directions.
Yeah, yeah. Oh, well, more importantly, just one direction, in my opinion. So if you're long gold, you want to, you know, you'd be selling calls, I guess, maybe on the option side of it. You know, but the option, like originally, guys, that's what options was designed for. It was designed for hedging. They've kind of turned it into a mainstream trading thing, when maybe it's not the best vehicle for just trading alone. I like the way you're doing it better, where you're buying the gold, buying physical gold or paper gold.
I have
Both, good.
But I have paper gold that is exchangeable at any time. And I can go to my bank and say,
Give me the gold.
give me the gold.
Like a futures, yeah, because nobody ever takes delivery. they just trade it on paper, right?
Yeah,
But
a lot of these gold funds aren't exchangeable against physical gold. This one is.
And that's my next. You answered the question I was just going to ask. You just answered it. So that's the smart way to play it. You're definitely on the right track. Yeah. So when we look at gold like that, we can see as gold's moving higher, every time the gold has gone up or down, the euro has followed it. There's a little tiny bumps in the road, and that's just interference from the ECB. That's what it is. And ultimately, the intermarket correlation comes right back. You can see as gold dipped right here, the euro did react to it, but it was able to recover only because gold did. So now as gold starts to advance higher, then we can see a bigger trade is absolutely forming. And these are the kind of things we want to look at. So immediately, pretty much, so right now, our trade's already turned positive. Our spread's covered. In stocks, it doesn't work that way. In options, you've got to pay going in, you've got to pay going out. In Forex, the second you take the trade, that spread's already worked in. That's what if I close this trade right now, our spread, our cost, everything is paid, and we go out with that money. Done deal. There's no additional costs here, no commissions. So as it starts to move up, there is no cost to exit this trade. That's where I try and stress to people, like when you look at the costs over the course of the year through a spreadsheet, and you look at all the money that you paid in costs for doing those options, for doing those stocks, and the amount of money, you've got to make a fairly substantial amount of money. But then if you look at the column on the left of what your costs are, they were substantial. Paying going in, even if it's only $4.95, $14.95, a penny per share, it still adds up. At the end of the day, it really adds up. So I just got to make sure I stay moving here. I'm notorious for going over, as the people in the back will tell you. That's not a bad thing. There you go. That's the kind of positive attitude I like. So when we look at this, we're just going to go back here, make sure we go back to our main charts. Okay, so while that's doing that, so we're applying the yearly. Now we're going to look at also identifying order flow. I get inundated with this question all the time with my own clients, with the funds that I work with. They talk about order flow, and order flow is very, very important. So order flow is very similar to trend lines, very similar. All we're looking at for here, guys, is identifying a couple of points where, you know, they may have different names for it. They could call it a wave, they can call it Gann theory, they can call it Fibonacci retracement, they can call it a million different things. Guys, don't get caught up in terminologies. Don't get caught up in complex theories that you don't really understand, or a doji, a spinning top. It sounds like a kung fu movie. Like, I don't know what's going on here. You know what I mean? There's two tops up there. That's all you need to know. Order flow, they're going to come in. Order flow guys are going to sit here like me, and they're basically stalking you is what they're doing. They're coming they're coming up and up and up, right? And they're watching for one pause in the market. And in this particular case with Great Britain, US, they're watching this area. They know that that swing top is up there, and this line, this trend line, is also, to simplify this down, is I can actually, even though I want to talk about that trend line, I'm going to remove this top one just for a minute. Okay, so we're going to hit this, clear this, double click on this. Okay, so in each one of these cases, the order flow guys are watching very closely, right? And they're always looking for 1 or 2 points in an area, and then they're going to look to buy or sell from. And whenever the market pauses, your order flow guys are going to come out of the woodwork, and they're going to, and I cannot say that I'm not part of that group, because I'm so you know, it's so just remember, whenever I'm always looking over your shoulder wherever we are. So when we come up here, again, I'm watching it's a zero-sum game, guys, so I'm watching everything that's happening. I see the order flow guys coming in right here. We've got a pause in the market right there. That's a horrible line. We've got another pause in the market right here. Order flow guys are going to look at this and they're going to say, okay, we know that our current market high was up there. They're going to draw a line straight across there without the trend lines, and they're going to say, look, we're looking to sell up here. So, and again, what I had talked about, I'm looking from VantagePoint for something to confirm that this is going to happen. And like just like giving a dog a bone here, they gave it to me. So like I said, we talked about that trade going in at the 126.80. When we started the presentation on Saturday, the markets were closed. I was up about, I think, $1,100. Now I've got close to $2,000. Right? That trade was based on order flow. It's based on the indicators from VantagePoint, the momentum indicators from VantagePoint. And when I started looking at order flow, and all you have to do is even if you don't remember how I taught you guys completely how to draw trend lines, then what I want you to understand is when that point forms, when you've got a move coming up, pauses at the top, and the next bar right beside it, all of a sudden, we've got no buyers up here. The order flow guys are the ones that are stalking you. And they're saying, okay, the junior traders are going to keep trying to buy Great Britain, US up here. And the order flow, all of a sudden, and order flow guys can be described as me, could be described as the broker, but it's somebody who knows or predicts what you're going to do. Daniel in the inner circle, that was a great thing you did at the inner circle there when you talked about the poker thing. And the guy won the poker based on intermarket analysis, because what he did is he anticipated what the people in that room were going to do, and he bluffed them. They know when they're going to bluff, when they're going to hold, when they're going to call. So this is the same thing that they're doing. They're betting on the fact that you guys are going to go with the trend, and you're not going to buck the trend, and you're going to try and keep buying this up here, and then they just hammer it lower. You don't want to get caught in that cycle. You remember that I showed you guys what to look for from VantagePoint. Medium-term predicted difference, crossing over the long-term predicted difference to the downside as the market's going up. In my respectful opinion, I believe VantagePoint is onto something with these predicted differences, where they're gauging, they're looking at all those other markets, and they're saying, people in this market are doing this, people in this market are doing that. We know what they're doing, and the probability is we're going to go the other way. So even if we look at order flow right there, there's a classic case right there. You remember what I said in the S&P 500. Why don't I have a trend line drawn up there? Why do I only have one down here? Well, we have to go to a higher point from there to draw our trend line, right? Over here, we don't have it. So that right there would classify as order flow. We've got a swing high, and in this particular case, it's a nasty one because it's an all-time high. We've never been up here on the S&P 500 ever. So there is nothing to draw on. So the second that market failed up there, nothing but sheer panic set in, right? And look at the next 2 days, 3 days, just got hammered. S&P gets pounded from 23, all the way down to 2270. Just so happened the VantagePoint 18-day predicted moving average was sitting at 2270, which gives us the confidence to say, okay, I think we might be okay here. So these are the kind of things we want to look for in our trading, is that if the market stops after a significant rally like this, and the other thing I want you to watch for in a swing high like this, on the very next bar beside it, you still have a great opportunity to short this S&P 500, because you can see that the bar closed in the lower 20%. We've got a swing top in place up there after a significant rally higher. And then all of a sudden, we didn't get a new high on that particular bar. We closed in the lower 25, 30% of that bar. You short the open of the very next day and down it goes. This is the kind of thing. And even right now, we've got a very, potentially, I think they're going to be watching this area on the S&P, and that's why I opted to close it. 2298, by drawing that on, you can see the last 2 days. Do you think it's a coincidence that it just stopped at that exact level of 2298 on the bar right beside it? Trust me, guys, that's not a coincidence. They're looking at this area to say, is it possible we can get long here? No, they're saying, I think we should stand down. And then we've got the DAX selling off, we've got the euro probably about to rise. So all of these things play into it, but the intermarket correlations can be fairly simplified. But in my opinion, this is going to spin off more into gold. It's going to spin off into potentially could push oil back down. There's a whole bunch of different things that could happen here. So I'm going to try and stay on time, so I've got some time to spend with everybody before I'm going to try and leave an hour to spend with you guys before I go to look at your charts. If you have any open trades, you want some advice on how you should manage them, what to look at going forward, I'm happy to do that. So we've looked at that. What else have we got here? We've looked at the S&P, we've looked at oil, we've looked at gold, we've looked at Euro, Swiss franc, we've looked at US, we haven't looked at US CAD. This is talking about trading hours here, US CAD. So right now, what I talked about with the guys and the Canadian is when they're trading Canadian futures, you want to be watching the US CAD pair very closely, and oil. So Rennie, your Canadian's probably in a bit, it's struggling a little bit this morning here. And this, and so basically, yes, I talked about with Rennie how to identify that stop and make sure that you understand where that is. So what had happened with US Canada, and this is where I'd really like to help people understand these trend lines. When a new one forms, and I told, and I think Rennie can verify it for the room, what I told you last night, I said I like the trade. Rennie is long the Canadian dollar, and I said I like it except for one thing. We have a brand new demand area formed right here. And that formed, we've got the low bar, 2 bars to the left, 2 bars to the right that are higher than this. We then have to connect it back to the next lowest point, which is back here. Sadly, that trend line is holding. And I suggested to Rennie last night that that is probably going to hold. I don't think the Canadian dollar is out of the woods I think it's still potentially going to strengthen, but that's going to be directly correlated to those oil contracts. So right now, with oil holding its ground, it still looks okay, but you remember what I said about the oil when we looked at that oil thing. We've got, when the US Canadian pair form that trend line, sadly, what I warned him of, I'm seeing the same trend line on the upside form on oil. So you can see that this bar right here, that swing high up there, 2 bars to the left, 2 bars to the right, lower than that highest point, you have the exact same formation in reverse on oil and US Canada. So when you're looking at that, you can say not only is a new base formed on US Canada, but we've got a new upper trend line supply area that formed on oil at the same time, and that's what I warned them of. That's my biggest concern. So right now, once again, the order flow guys step in, they see a swing low, and they don't hesitate. They bite on that thing immediately. You'll notice our Euro US kind of floating around here, plus $20, $30. From the second I took the trade, it's never been down any more than $2, right? Because we went through the proper intermarket correlations and said, look, we've identified the supply and demand areas. With the Canadian dollar, we want to do the exact same thing. I said to Rennie, I could show you how to trade the Canadian dollar futures or the US Canadian pair without even looking at the US-Canada chart, but that was a little cocky. I still look at it very closely because when I looked at them both, I saw, in my respectful opinion, I saw the same thing in reverse. The Canadian dollar long futures, oil with a top potentially forming in place. We've got, once again, bringing in everything that I've talked about again this morning, the yearly opening price, how it's struggling to get above that area. We've got a whole bunch of problems going on here. So it doesn't mean that the trend, that the Canadian dollar can't strengthen, it just means that it's really, really struggling. So when I look at the yearly opening price on something like the US-Canadian pair, we can see that right now it is predominantly bullish, the Canadian dollar. The yearly opening price, right up around the 134.36 area. So you can see right from January, 3rd of January, 4th of January, the Canadian dollar strengthened substantially. And we went over a lot of this with Rennie. And what I also talked about here too was the inside bar. When we talked about that inside bar, Rennie is able to place his stop in the proper area, knowing where that breakout point was. And if that inside bar gives way, then I said cut it, because Rennie has a great trade on that. It's in good profit. You want to protect that profit. You always have the opportunity to go back in. You can see when I talked about the inside bar using US-Canada, this is our mother bar, so we have a significant move, the bar right next to it. The high and the low is inside the mother bar, okay? This creates our next trading range. You'll see that what I've talked about in Saturday's presentation, and I'll reaffirm it here, the second we broke below here, and VantagePoint 100% confirmed that. The inside bar was simply a way to confirm it, saying, look, we've got a big move to the downside. I'll just zoom that in so everybody can see it. I'll go to 1 month. So again, you can see VantagePoint confirming it on that inside bar, and down we go. So again, it's very, very powerful to look at these things, and when it breaks down like that, there's a trade there for us. Not only that, but it tells us where to put our stops. Because if that goes back around the other side of the range, just cut it. Like most people think that they didn't get enough profit, they didn't get in at the right time. As long as you're taking profit, guys, it doesn't matter. You can always go back into this trade. As long as you bank that profit, you take that money, you've taken money from the market, you didn't let the market take money from you, then you're winning. And if you do that, multiple times, it's shocking at the end of the month how much this all adds up. So I'm running dangerously close here. Okay, I got a few minutes. We're looking at US-Canada. We've talked about that, the yearly opening price. And we've again talked about order flow. So the order flow is, again, a very significant way of looking at things, because as you can see, in this particular slide presentation, I've removed the moving averages to try and take a little bit of the confusion out of it for you guys, so you can clearly see it whenever a swing high, whenever we've had a big move up, right? And even there's a cute little inside bar right there, right? We put a line across there, we buy it to there, but the very next bar beside it, we've got a pause in the market. So when we see that pause in the market, remember, it's me looking over your shoulder. It's the broker looking over your shoulder. They're getting ready to pounce on you and run those stops. So make sure you're locking that profit in, and you can make sure you're getting out with that.